Hey everybody, it's Joey from Universal CPA Review. Some of you might know me as Ask Joey. If you're studying for the CPA exams and you consider yourself to be more of a visual learner, you've come to the right place. So don't forget to subscribe to our YouTube channel, join our Facebook study groups, and our Reddit community. You can find the links to those in the description below. Okay, so we have now talked about how to report for both operating leases and finance leases on the lessee side. So now let's talk about Gustavo Autos on the lessor side. As we said, lessee accounting is a little bit more straightforward, right? Bare bones logistics just needs to determine if this is going to be classified as an operating lease or a finance lease. Gustavo Autos is considered the lessor, so Gustavo Autos needs to determine if this lease is considered an operating lease, a sales type lease, or a direct finance lease. Okay, so not going to be simply an operating lease or a finance lease on the lessor side. Okay, so on the lessor side, this finance lease is now getting broken out into either a sales type lease or a direct finance lease. So it's going to first and foremost be important that we truly understand the differences in these types of leases. Okay, so if the lease is classified as either a sales type lease or a direct finance lease, the asset is getting derecognized off of the lessor's books. Okay, so at a high level, you need to be able to differentiate between these two types of leases. And while a lot of people like to get tripped up on this concept, we're going to break this out into another digestible format. All right, so we're going to pull out our mental map on the lessor side. And instead now we're going to think of these lease classifications as a list of options, and we have 3 options instead of 2. Okay, so on the lessee side, we talked about the fact that we only need to meet one of these bones criteria to be considered a finance lease. If the answer is it doesn't meet any of the bones mnemonic, then it would be classified as an operating lease. Whereas when we're on the lessor side, we now have 3 total options, like we said. Okay, so option number 1 is going to be our sales type lease. Okay, so when we think about our sales type leases, we're going to think of this as a pure sale. All right, so we're on the Gustavo Autos side of the negotiating table. Option number 1 is that this is a sales type lease. Okay, so in order to do that, we just need to see if the lease meets one of the bones criteria. Right? Does it have a bargain purchase option? Does ownership transfer? Are the net present value of the minimum lease payments plus any guaranteed residual value by the lessee at least 90% of the fair market value? Is the lease term at least 75% of the lease's economic life? Or does the asset have a specialized use, right? AKA, is it considered specialized? If the answer is yes to any of these 5, then it would be considered a sales type lease. All right, but what if it isn't considered a sales type lease? Right, what if we do the dance, we run through all 5 of these, and we've determined that none of the 5 criteria exist? Well, then we move into option number 2, and we need to ask ourselves, is this considered a direct finance lease? So we need to now determine if the extra 2 sets of criteria are met. Okay, so we need to determine if the net present value of the minimum lease payments plus the guaranteed residual value by third parties exist. But Joey, I thought if the net present value of the minimum lease payments plus the guaranteed residual value is greater than 90% of the fair market value, then it's considered a sales type lease. Okay, so let me stop you right there. What's the difference between the two? It all comes down to the guaranteed residual value, right? I know this is such a crazy detail, but basically we're saying that if the guaranteed residual value is guaranteed by somebody that is not the lessee, then it could still be classified as a direct finance lease. If it is guaranteed by the lessee themselves, then it's possibly a sales type lease. Okay, so this guaranteed residual value can be thought of as similar to the salvage value of a depreciable fixed asset. Right? Somebody's making a guarantee that this asset will have value at the end of the lease. Okay, so in addition to that, lease payments plus the guaranteed residual value are considered probable and collectible. Okay, and in this case, both of these criteria must be met for it to be considered a direct finance lease. All right, and if none of the first 5 bones criteria are met, and none of these additional 2 criteria are met, or if even one of the 2 additional criteria is met, but not both, then we would move to option 3, and by default, this would be considered an operating lease. Okay, so if it is considered a direct finance lease, I want you to think of this as a pure debt agreement. If it is an operating lease, I want you to consider this as a pure rental agreement, right? We'll dig more into that in just a second. Okay, so just like we needed to understand the journal entries for the lessee, we also need to now understand the journal entries for the lessor. Okay, so on the lessor side, we have 3 different options for classifying these leases. Okay, so option number 1 is that the terms of the lease include one of the 5 characteristics within the Bones mnemonic, which would result in the lessor classifying this as a sales type lease. So what does it mean to classify the lease as a sales type lease? Well, this can be thought of as a pure sale. So if the lessor is selling the asset or treating it as such, then we know that we need to record a gain on the sale if the fair market value is greater than the net book value. Okay, so for lease purposes on the exam, you can go ahead and assume that the fair market value will equal the sales price. All right, so don't get too bogged down on comparing the sales price versus the fair market value to the net book value. Okay, so what else do we need to record for sales type leases? Well, we also need to record both the principal and the interest amounts that are received by the lessor. Okay, so thinking about this intuitively, the lessor, Gustavo Autos, is providing the lessee, Bare Bones Logistics, with this leased asset. In exchange, they're going to be receiving these lease payments. Okay, so some of this lease payment amount will be allocated to the principal, and some of it will be allocated to the interest. All right, but in the first transaction, right, this initial transfer, the lessor is going to record a gain as if this was a sale. So that initial journal entry will include a debit to the lease receivable, and this is going to equate to the present value of the minimum lease payments. Right, we're just taking the payment amount and multiplying it by the present value factor. And on the credit side, we're going to credit the asset at its carrying value and also credit the gain should it exist. Okay, so in this case, the sales price is greater than the carrying value. Okay, so again, fair market value, same thing as sales price for this purpose. Okay, and then when it comes time to pay the interest, they're going to then have to record interest income and also the reversal of that lease receivable. Okay, so this is another way of saying the reversal or the reduction of the principal amount that is owed. Now, if this was a direct finance lease, we're essentially saying that it doesn't meet one of the Bones criteria, but it does meet both of the direct finance lease criteria. And that is one, that the present value of the minimum lease payments plus the guaranteed residual value, which is guaranteed by a third party, and the lease payments plus that guaranteed residual value are considered both probable and collectible. So again, it doesn't meet any of the first 5 Bones criteria, but it meets both of the 2 direct finance lease criteria. Okay, so you could think of this as Gustavo Autos leasing that asset to Bare Bones Logistics at the exact same price that it caused them to purchase it. So why would this be? Because if it is a direct financing lease, by definition, they're not going to be recording a gain on the initial transaction. Remember, if this was a sales type lease, they would also record a gain as part of the profit that is getting recognized. So if this is a direct finance lease, the only time that they're going to recognize a profit on the lease is from the interest payment. Okay, so they're still going to receive that periodic lease payment, and when they do, they're going to allocate it to either principal or interest like they would as if this was a sales type lease. So previously we mentioned that we want you to think of the sales type lease as a pure sale. When it comes to a direct finance lease, we're going to think of that as a pure debt agreement. So again, no gain on the initial transaction. So the initial journal entry for a direct finance lease would simply be a debit to the lease receivable and a credit to the asset that Gustavo Autos is providing to Bare Bones Logistics. Right? Ultimately, no gain is getting recognized here. Okay, but they're still going to allocate this lease payment when they receive it to either interest or a reduction to the principal that is owed. Okay, so they receive that cash payment, which is going to be debited. They're going to credit the interest income and credit the principal that is getting reversed. So in other words, they're just going to credit that lease receivable. All right, so on the lessee side, they're reversing out the lease liability. On the lessor side, they are reversing out the receivable. Okay, so at the end of the day, sales type leases and direct finance leases are going to be important to differentiate. And while it can feel rather complicated, understanding these journal entries is going to be essential. Okay, so we're cranking down our checklist. At this point, we've noted that none of the Bones criteria have been met, so this is not going to be a sales type lease. Okay, so we also know that the net present value of the minimum lease payments and the guaranteed residual value by a third party, or the fact that the net present value plus the guaranteed residual value is not considered both probable and collectible, thereby asserting that this cannot be recorded as a direct finance lease either, will tell us that now by default we can classify this as an operating lease to the lessor. So if this is considered an operating lease, this tells us that the lessor, Gustavo Autos, will not derecognize this asset from their books. So we thought of the sales type lease agreement as a pure sale. We thought of direct finance leases as a pure debt agreement. When we think about operating leases, I want you to think of this as a pure rental agreement. Okay, so some quick hitters. The lessor is going to keep this asset on its balance sheet. Okay, so it's not getting transferred as an asset over to the lessee. The lessor is going to recognize income on a straight line basis. And because the asset remains on the lessor's books, it is the lessor that will depreciate the asset as well. So that means that the lessor will need to record the depreciation expense and the associated accumulated depreciation. Okay, and when the cash comes in, they're simply just going to record a debit to cash and a credit to the rental income. Okay, so sales type lease example. On January 1st, year 1, Bare Bones Logistics leased a truck from Gustavo Autos that will require that Bare Bones Logistics makes 4 payments of $15,000 over the 4-year lease term with an implicit rate of 5% and an incremental borrowing rate of 7%. We have a present value of minimum lease payments that amounted to $66,424 at the date that the lease commenced. We also know that the truck had a fair value of that same $66,424 amount, but a book value of $62,500. So assuming that this is a sales type lease, we want to determine the initial journal entry and the interest income associated with the periodic lease payments. Okay, so the first thing to note is because this is a sales type lease, we're going to think of this as a pure sale, right? So that means that there is a gain that is getting recorded in this initial transaction. Okay, so we know that the present value of the minimum lease payments is $66,424. So that's going to get debited. On the credit side, we're going to credit the asset at its carrying value. And the gain will be recognized as the difference between that present value of the minimum lease payments and the carrying value amount. Okay, so this is the first profit that is getting recognized by the lessor. But they still have to record the interest income associated with the first periodic lease payment. Okay, so the debit to cash represents the lease payment that they are receiving. So now they must allocate the lease payment amount that they received to interest income and to the reversal of the amount that they were owed. So the first step is calculating the interest income. So we know that the present value of the minimum lease payments was $66,424. This needs to be multiplied by the implicit rate of 5%. Okay, so interest income is thereby calculated as such, and the difference is going to be the reversal to the amount that they were owed. Okay, so when we talked about this on the lessee side, we were reversing the lease liability. Now on the lessor side, because it is this party that is getting paid, we're going to be reversing the receivable. Okay, so if this was a direct finance lease, this would be the exact same scenario. The only difference is that we wouldn't have a discrepancy between the fair value and the book value for this leased asset. Okay, we also see that this is classified as a direct finance lease. So this tells us that there's no gain that is getting reported in the initial entry. So we're just going to have a debit to the lease receivable for the present value of the minimum lease payment amount and a credit to the asset. And that would be for that same amount. Okay, and then nothing's changing when it comes to recording the interest income. We're going to take the present value of the minimum lease payment amount, multiply it by the implicit rate, and that is the amount that is allocated to interest income.